Hello, I'm Dan Coatsworth, editor of Shares magazine. Today I'm here with Tim Stevenson from the Henderson EuroTrust. Hi Tim. European equities have done very well this year. Do you think that's down to improved economic strength, or is it down to something else?
Well, I think it's more than just the improvement in the economies in Europe, which we've seen. I mean, we'd expecting that for quite some time. I think the other very important thing, obviously, has been the removal, if you like, of some of the political risk. A year ago, you've got to remember, in the aftermath of Brexit, it was felt by one or two people that Europe would completely fragment and we'd have complete political chaos in Europe. In reality, the Dutch have been fairly rational in terms of their vote, and the French have been very rational in terms of electing President Macron. So the removal of that sort of political risk, if you like, at least for now, has certainly helped. But the fact that the earnings are coming through as well on the back of that good economy, that's really helped European markets.
Part of your trust strategy is to back companies that are undergoing significant change. How patient are you when it comes to wanting to see positive results from this change?
Yeah, and that's part of the fund strategy. I mean, there are about 4 or 5 different themes in terms of sort of long-term growth, long-term change and so on in a low-growth world. But in terms of patience, I mean, that's the crucial thing, particularly nowadays in the sense of sort of ETFs jumping around, fast money, hedge funds and everything else. Sometimes the short-term reactions in the market are quite painful to watch when you sit there and think, why is the market reacting this way? So there's a sort of narrow dividing line between patience, if you like, and kind of negligence in terms of just forgetting that something may be going wrong. So trying to sort of put that into a time period is very difficult. It comes case by case basis. In our view, we tend to give things 6, 12, 18 months, 2 years, and then we like to sort of see things really panning out as we'd expected. Remembering, of course, that with the strength of the European team, we meet an awful lot of companies. So we're pretty well keeping in touch with these companies on a 3-monthly basis with their quarterly results. But also then perhaps 3 monthly, we're meeting some of the companies every 6 months, once a year, that kind of stuff. And just gauging how much of that sort of longevity, that sort of long-term case is still actually intact and how much of it is just pure noise. So it's difficult to say whether it's a sort of 6 months period, 3 months period. It's much more likely to be sort of 12, 18 months, 2 years. We find good companies and participate in their future. That's what we're trying to do.
On a broader scale, where do you find growth in a low growth world?
I think it's a very fair point. But again, if you look just purely at demographics, taking that as an example, everybody complains about the demographics and points out the danger of the demographic, the aging and so on, the fact that there are fewer younger people coming into a population. And I think this is highly relevant, but there are two sides of demographics. One is the fact that most governments have to move the burden of funding pensions away from the state to the individuals. The individuals have to save for their own retirement. That, in a sense, provides a big growth opportunity for those companies that can make some kind of cost-efficient, effective way of helping people save for their own retirement. That's a big growth area, and we're investing in companies that can benefit from that particular theme. And then there's the healthcare side of it. People are getting older, are getting more ill. There's the new drugs coming in, but above all, there's actually the whole healthcare as opposed to just purely pharmaceutical aspect of growth. So there's 2 examples. Technology is another example. Everybody thinks that America leads in all things technological. Absolutely not true. SAP is way ahead in terms of its products for enterprise resource planning compared with a company like Oracle. Amadeus is a unique company. It has developed fantastic technology to help airlines manage their capacity better, to help airports manage their capacity, but that's now also moving into hotels. So there are just 2 technological examples. You could name Infineon as well. These are some of the things that are actually growing very well in what I believe is long-term still a pretty low growth world.
Now, you like to invest in companies where you perceive that the markets undervalue them against their growth prospects. When do you actually like to sell? Is it once you think that the market is re-rated, or do you want to keep these companies for as long as possible in the future with the hope that growth would be sustained?
Yeah, it's always a very difficult question to ask that one, to answer rather. It's easy to ask, but answering the question is tricky. I look at something like Inditex, which we invested in when it IPO'd in 2001. And there are a number of times where I've looked at Inditex over the years and felt that this stock is now too expensive. And the question I've asked myself each time when I've come to that is, how developed is this company? Can it continue to grow? Can it continue to give us a total return of around about 10%, maybe a little bit more, over the next few years. So can it generate enough sales growth? Can it continue to generate some earnings growth? But also, can we get some dividend yield and some income from that? And if the answer to that comes out that we still can, then how am I to judge whether 23 times, 20 times, 25 times, 28 times? What exactly do you actually pay for that? If this is a good company, it's far less relevant how its sort of actual snapshot and the picture at a moment in time looks in terms of whether it's exceptionally expensive or not. The real question is can it continue to grow and to meet market expectations? So I'm very reluctant ever to sort of say this has now become at a ludicrously high level, although clearly one does get nervous.
With the hope that growth would be sustained. And finally, what's your outlook for European equities for the rest of 2017?
The rest of this year, well, what are we looking at now? Sort of 3 to 4 months left of the year. Europe has done exceptionally well. In fact, all markets have done very well. From the sterling investor, there has been quite a big gain because sterling has weakened. And frankly, the way I see sterling and the mess in the UK, I can't really see how sterling is going to strengthen much until we get out of all this Brexit mess that we're in. It depends what your starting point is. I'm very gloomy about the UK. I think it's got serious problems. Europe has got a lot of things going for it. The economies are well set, earnings are coming through, dividends are being increased. The political situation is far better. There's a whole bunch of things that really stack up. Your next question then is the sort of weight of money. Is everybody already well positioned in Europe? And I do get the impression that people still are neutral or only very small overweighted in Europe. And from a valuation perspective relative to the United States in particular, European markets still do look attractive. Relative to interest rates in Europe, we've got the long bond yield in Germany now at around about 50 basis points, 0.5%. I don't think that's a headwind. I think even if the long bond yield in Germany goes to 80 basis points or 1% even, I don't think that actually stops these markets holding up quite well. So I'm not complacent, you never can be, but I think Europe is set pretty fair.
Thanks, Tim, and thanks for watching.